Hello and welcome back to another video. Today I'm talking about why I've decided to ditch and sell all my HMOs. For those of you that don't know me, my name is Marco. I'm a portfolio landlord, property investor, developer and mentor. And I'm very passionate about helping people invest in property. Now make sure you stay tuned to the very end of this video because I'm going to be giving you 7 reasons why I've decided to get rid, sell and ditch all my HMOs. So number 1 is that HMOs cost more to maintain and you have to maintain them more often. And for those landlords that also have HMOs, you'll know exactly what I'm talking about. And it's because obviously there are more people living in a HMO by the very definition of house of multiple occupation, and a HMO is where 3 or more unrelated people are living in the same dwelling. So yes, you've got more people living within the building, you've got more footfall, more wear and tear, so maintenance needs to be done more often, and obviously this costs more because you're doing the maintenance more often than you would do on a single let. Now the second reason why I'm ditching all my HMOs is that there are stricter regs and rules when it comes to HMOs. Again, for those landlords who have HMOs, you'll know exactly what I'm talking about. So HMO licensing in some areas of the UK where, your property has to have a license if you legally want to use the property as a HMO. And again, to obtain this license, you have to do quite a lot to the property, and it will cost you a lot of money to get that property to that standard and to keep to that standard, again, compared to a single buy-to-let over here. Now, don't get me wrong, this isn't a deal breaker, but when you compare the HMO licensing to single let regulation, it's so much easier to operate in the single let space. So the third reason why I decided to sell and ditch my HMOs is because, in my opinion, HMOs are more riskier than single lets. And let me propose a question to you now. Let's say you have a student HMO and it's let to students for the academic year. Well, what if you don't manage to let or find students to take your property for that academic year? At the worst case scenario, you could be having no rent for that year, or maybe you've managed to let it out at a discount, or maybe you've changed it to some type of other accommodation. And this risk and uncertainty now is really important because as the rental reform bill is coming through, as it stands, a tenant can give notice from day 1 of moving into your property, irregardless of the fixed term. So again, imagine you've got students coming into your property and for whatever reason, they change their mind and they don't want to rent your property anymore. Again, you could be struggling to fill that once they vacate. Another risk as well that we need to think about is the council tax and council tax banding. There are councils in the UK that are looking to band rooms individually rather than a single property. And again, depending on how you're wording your contract and your AST, you could be liable for that increase in council tax. So for me, this is why, again, I'm getting rid of my HMOs. I see the regulation, I see the risk, and for me, I'm not happy with it. So another reason why I'm getting rid of my HMOs is I've seen in my figures over the past 3 years especially, is there's a huge variance and fluctuation between your gross yield and your net yield. Because typically, when you have HMOs, you'll let them all bills included. And for anyone in the UK, you'll know that energy prices have been crazy the past couple of years. And this difference and fluctuation between your gross and net yield really just makes it quite difficult to understand how much you're making from the property, especially if you're borrowing money. And if you're borrowing third-party money, from other and private investors, again, it makes it very difficult to plan and to forecast. Because there's uncertainty and risk regards to the ongoing cost of a HMO and the bills, again, that's one area why I'm looking to exit this industry. So the next killer question I want to propose and ask to you is, do you think a HMO is going to increase in value in line with the average property in the UK? It's a question to answer, and personally I think no, and here are the reasons. Well, a HMO is an investment property, and yes, a HMO could be turned back to a C3 property, which means it's used for people living in the property themselves, a family, whoever. But actually that rarely happens, and a lot of people who are wanting to purchase their own home can't see past that investment property. They can't visualize that investment property being their own living property. So because of this, you've gone from 100% of the market up here, which are both investors and people who want their own home, all the way down to here, which are just investors. And there are only a few investors in the market compared to people looking to purchase property for their own home. So because of this, I don't think the values of HMOs increase in line with the average property prices in the UK. And one other thing to note here is sometimes HMOs are valued and priced based on their yield. And again, the yield is dictated by the rent, not so much the increase in property prices, the bricks and mortar property prices. So yes, if you're looking for long-term capital appreciation and long-term wealth through your asset, personally, I don't think HMOs are the way to go. But we already know that. HMOs are great for cash flow. HMOs are great for short-term, for high yields. So yes, when I started in property, I started with HMOs and they did really, really well for me because they gave me lots of cash and in a quick manner. But yes, I know the capital appreciation for the HMOs weren't going to be great compared to, say, a 3-bed semi, which is absolutely ideal in a nice area with strong fundamentals. So another really key point before we move on to something slightly different are interest rates. And as we know, when interest rates rise, property prices become less appealing. They don't necessarily fall, it's just property becomes less attractive because you have to pay more on your mortgage. Now this is incredibly even more so important with HMOs and with investors because a lot of investors buy HMOs with finance and with mortgages. So that's something really important to know. When the base rate is high, when lending rates is high, the value of your HMO, and if you're looking to sell, may not be the best time to sell. And again, you may want to think about holding on a couple of years, a few years until rates decrease, and that investor, whoever's going to buy your property, can potentially make more money and therefore can afford to pay you a higher price for your property. And obviously, it's really important to mention that lending rates on HMOs are normally slightly higher than a typical single buy-to-let property. So I've listed lots of reasons why I don't like HMOs anymore, but let me just summarize the most important reason for me especially and where I am in my portfolio at the moment, and it's time. HMOs are more hassle and more time than single buy-to-lets, without a doubt, and any portfolio landlord who has both HMOs and single lets in their portfolio will tell you that they will spend a larger share of their own time addressing to that HMO than tending to that single buy-to-let property. For me, time is more important than anything right now, and if I can buy time, I would. And here's a little formula for you to work out for your own portfolio, or maybe for a potential acquisition going down the line. Don't think about how much money a property can make for you. Think about the hourly rate. How much is that property going to be making you on an hourly rate? Not a flat out figure that you're making every month or every year, but every hour. What's that going to be? Because I guarantee, even though you'll be making less cash in a single let compared to a HMO, you'll be making less cash on a monthly basis. Actually, when you look at it at an hourly rate point of view, you'll be making more because that single let over here hardly requires any of your time, where a HMO over here will require much more of your time. So just a way of thinking that I really want to open up to everyone here watching this video is, what is your hourly rate? And be buying property with this in mind. And again, this is why I don't do serviced accommodation, or one of the reasons why I don't do serviced accommodation, because yes, you can make lots of money in it, but actually once you've put all your time, effort and energy into serviced accommodation, what is your hourly rate? Probably less than a single let. So that's my kind of honest confession and the reasons why I'm selling my HMOs and moving away from that sphere. Yes, it's been really kind and very generous to me over the years, and don't get me wrong, it's still a good strategy, and if you want to go down that strategy, there's lots of money to be made. And especially if you're looking to get into property, it's a great way to get into property with a higher yield than a single let and to get that cash flow in the short term. However, for me, in my portfolio and speaking to other investors, once they hit a certain level, what they want is more time, not less time. And yes, maybe you're willing to forego maybe 1 or 2% on your short-term yield to actually make more money over the long run in an increase in value, and more importantly, to get some time back in your life. So I hope this logic and these reasons have really added value to your property investing journey. And pop in the comments, do you disagree with me? Do you have anything else that I've missed out maybe? Or what exactly are you investing in? Comment below, I'd really like to hear your opinion. Now I must end this video with a slight caveat. There is one particular HMO strategy that is very profitable and still even to this day, even though it is quite saturated. And this is where you're buying properties that are currently C3 properties. And what this means are they're just standard normal properties that maybe families live in. They're not HMOs at the moment. And legally converting a property from C3 to C4. Now a C4 is classified as a HMO, a house in multiple occupation, where 3 or more unrelated parties live in the same dwelling. So there's still a lot of money to be made here in this industry, even though lots of areas in the UK have what's called an Article 4 direction, which basically prevents you from doing this. But there still are areas in the UK you can legally do this and make loads of money just by converting this property to a HMO and increasing the value because you've increased the rents. Maybe you can then sell it on to someone else or keep it in the portfolio and look to duplicate that strategy. Now I've got one question for you. Are you looking to build and scale and grow a property portfolio? Maybe you're a complete beginner beginner. Or maybe you have 2 or 3 properties, something like that, and you really want to fast track and grow your portfolio. Well, I'd love to work with you. I have a coaching and mentoring service that may be suited to you. If it sounds of interest, head to my website, ms7.uk, click on the coaching and mentoring page and book a call with me. I'd love to have a chat with you and see if I can help. There's also a link in the description, so I'll leave that there. All the very best with your property investing day. Take care. Goodbye.